Okay. Hi everybody. Hi Dr. Nick. This is Lee Gregerson doing a video. This is a bit of a different than my usual video. I have Shawn here with me. This isn't going to be a mental health interview. Shawn went to business school and at Northern Alberta Institute of Technology, as well as having studied chemistry at the University of Alberta. And I go to Shawn quite a bit when I want to know about what's going on with the markets and where to put excess money, different things like that. And Shawn's constantly analyzing the markets. And so yeah, Shawn, I'll let you speak. It being July 2nd, 2013 right now, can you tell me where the markets sit as we speak?
Okay, first of all, I look at a variety of different indicators. I try to predict the global economy to the best of my abilities. Basically, I look at unemployment rates in around the major economies of the world. I look at consumer and business debt totals. I look at a variety of things. I think for the month of July, this month of July 2013, the first few days for the global economy and for the global stock markets will be a bit of a downward trend. But the rest of the month, after that downward trend, that initial downward trend is over, it'll be a roughly positive month for the global economy.
Now, I understand you own some Apple stock, so what first got you into owning Apple?
Well, what happened in 2008 was something I was expecting to happen: a global markets, stock market sell-off, and a lot of good companies with good management were being dumped unfairly with the bathwater. I liked Steve Jobs. I thought he was one hell of a CEO. I thought at buying Apple, 45 or 50 shares of Apple, maybe more, I can't remember the exact how many number of shares I bought, at $85 per share, I felt it was a steep bargain, just a royal bargain. And I kept it for a few months later when I found out that Steve Jobs, the founder of Apple, who also came back to Apple and started their renaissance, and the guy behind the iPod, the Nano, the iTablet,
all of which I've owned myself.
Yeah, when it got revealed that he had cancer, I sold my shares immediately. I'm sure Apple's a great company. I'm not disparaging the stock, but how do you replace a guy like Steve Jobs? You can't. There's only people like that, whether they're male or female, black or white, people who build a huge, successful company based on their ideas and judgment. Those kind of people are rare. I'm sure Apple's got a great management team after former CEO and founder Steve Jobs passed away. But I'm just saying, they've started to suffer since then. The stock price has gone down from somewhere around $700 American per share to somewhere around 400 something, if not lower than that.
Now, I can recall, I've read this book, The Richest Man in Babylon, and I'm planning to do a video on it. You can actually find people reading the whole book right on YouTube here. Just type in The Richest Man in Babylon and you can read the whole audio book out through your computer. But one of the things that it talked about was how you can get advice from anybody, but if you want advice about stocks, you go to a stockbroker. If you want advice about money, go to somebody that deals with money every day. If you want advice about business, go to someone. Well, I went to, and Shawn supported this, Shawn backed me up on this. I went to a local pawnbroker who was in his 70s and made a lot of money. He was very wealthy, just from a small pawn store. And I asked him, I said, I have about $1,000 and I want to put it into something. And I said, what should I do? And he says, well, go out and buy silver, and you buy silver bars and you hold on to it and you don't do anything. And when I told Shawn about this, he was very supportive of it. And at the time, I think it was at about $11 to $14 that silver was going, and when it was at its peak, silver was trading at about $60. Now, I didn't hold it the whole time, but this was something Shawn recommended, and I wanted to discuss this with him. When you were telling me to buy silver, what were your indications that it was going to... Was this something you found in the paper? Was this something you would analyze for, or commodities, or...
A mix of both. I've been studying the market ever since June 1st of 1991. I advocate never stop learning. There's some things you can't learn in a business classroom. You learn in the pages, the financial section of a good financial newspaper, like the Toronto Globe and Mail or the National Post, which is what I subscribe to. Basically, the Western European countries and North American countries and the UK, they borrowed a lot from Asian nations. They sell their treasury bonds to Asian nations and the emerging nations, and in return they get money to run their country's government. Now, when the debt levels start to get really high, and there was a lot of bad assets in a lot of North American and Western civilization banks, I got really worried about that, and they had to drop interest rates really low to stimulate the economy. When interest rates are low in a country, no matter what country in the world it is, it costs less for people and corporations to borrow. And that starts a chain reaction which makes them build more factories and hire more people to expand their operations. Now, when interest rates went down to 1%, and less than that in some cases, in the European Union, the UK, and the American Canada as well, basically the interest rates were low, and their currencies lost against other currencies of the world, other stronger currencies in the world, because their interest rates are low. When the interest rates in a country are very high, basically it makes their currency-denominated investments, like such as GICs, Guaranteed Investment Certificates, and CDs, Certificate of Deposits. Notice that in high interest rate economies around the world, they pay more when the interest rates are high. And when interest rates are low, you sell your fixed income securities and you buy stocks. The way fixed income works is that, like just say a treasury bond or regular corporate bond. Basically, they're designed in such a way that when interest rates are high, the price of those bonds are low. And when the interest rates start to go downward, the price of the bond or the treasury bond or corporate bond goes up. And since interest rates were low, you weren't making much on GICs and treasury bonds and certificates, bank CDs, certificates of deposit. In America, whenever you want to buy a commodity around the world, it could be a food commodity or a precious metals or oil, no matter what the commodity is, you have to buy it in American dollars, and when the quality of the American dollar goes down, because they keep the interest rates artificially low for such a long time, the price of the food commodities and the precious metals and oil as a commodity, the price of those things go up to make up for the weakness in the American dollar. And what happens now is that one of the reasons why gold and silver were doing well until just a few weeks ago is because interest rates are low and inflation is much higher in Western Europe and especially in America that is generally known. And when interest rates are low and there's a lot of inflation, the price of gold and silver go up to make up for the weakness in the American dollar and also as a hedge against inflation. If a lot of Western European countries have and North American companies and countries have low interest rates and high inflation, you can always use gold and silver, especially gold, as a medium of exchange, like gold coins and stuff like that.
Now, I can recall personally when I was a young kid watching the stock market channel. We had a very simple computerized stock market channel. Out of 13 channels that we watched, and we would watch the price of gold going up and up and up, and I believe it got to $900 at one point, whereas like recently gold was at $1,900, which is much more, $1,000 more, but with inflation and all that, probably somewhere equal, and then it sunk down again. Now. When I saw it go to $900, that must have been 30 years ago, and then it went to $1,900. 25 years later, or 28 years later. Are we going to have to wait another 28 years to see gold make that kind of a move again? Do you think, or is this something? Is there a time to buy gold again? Like silver is dipping, gold is dipping. Is it almost time to start getting back in?
Well, I'd wait just a few more months. I think there's still some downside left to go.
What would be an indicator if you were to wait a few months? What would be an indicator for my viewers, I guess?
Okay, wait for it to bottom. Wait for the selling to stop.
Yeah.
Central banks around the world, especially the Federal Reserve, the central bank in America, the Federal Reserve said they'd be withdrawing stimulus. They'd be tapering it, not removing it altogether. When that happened, gold went down one hell of a lot. As of Monday, July 1st, 2013, gold closed yesterday at $1,255.70 American per ounce. I think the reason why gold went down from 1900 all the way down is there was this perception that central banks in Western Europe, the United Kingdom, and North America would start raising rates to head off inflation. And when interest rates go up, that means they can afford to give more interest on GICs, CDs, treasury bonds, and corporate bonds, and that makes the value of gold of lesser value. Since when the American dollar gets stronger because of raising higher interest rates, eventually, like I think what was the perception of higher interest rates around the world a few weeks ago and months ago when gold started to drop from 1900 to 1255 US per ounce. I think what's happening is that the thought of inflation, the American dollar is getting stronger again, and then to make up for that increase in the strength of the dollar, gold and silver went down as the American dollar got stronger, and it's the same way the other way around. And
so we're looking for a decrease in the value of the American dollar as compared to world currencies or Canadian dollars?
Americans are starting to raise their interest rates, or at least they give the impression that they would. And
when
interest rates go up, that country's currency goes up in strength against the other country.
Oh, okay.
And then since you have to buy commodities like food commodities and precious metals and oil in American dollars, when the American dollar gets stronger because of higher interest rates in that country, basically the value of commodities around the world go down in value because the American dollar is getting stronger.
Okay. So we're looking at holding back on commodities. Now I read somewhere that, I'm just going to set this quickly here. Okay. YouTube restricts most videos to about 15 minutes or so.
Yeah.
And 2 megabytes or 2 gigabytes. So we haven't got a whole lot of time. Let's fix my hair. Now something I heard or read was that the best way to manage a person's finances is find something you're good at. Start a small business doing that. So when you start a small business, if you work hard enough or if you work smart enough, you're going to make a better income than working for someone else if things go well. And invest in a house, have a home to live in that's worth something. And how would you say this is a good time to buy a car, buy a house? How would you say that houses now in Edmonton? I remember as a kid, for almost my whole young life up to at least age 25, the price of a house was almost standard at $100,000.
Right.
But now, like this house Shawn and I share is probably at least a $400,000 house.
Right.
And how do you feel about that? How do you see the housing market going? How do you feel? How do you see the opportunities of opening a business?
Well, I think in the short term, housing prices in Canada and the United States should stay stable. But the thing is, interest rates are slowly going up. The central banks of the world, they're withdrawing part of the stimulus. They're going to raise interest rates a bit. Mm-hmm. But I think interest rates are low to begin with, and if they do raise interest rates, it won't be that much. But what banks do around the world, especially banks in Canada, the United States, and Western Europe as well, basically banks are starting to charge each other more for sometimes one bank in a country will borrow from another chartered bank in that country to keep their reserves at a certain level. Mm-hmm. Now I think interest rates are going up, but they're not going up a whole lot, because when interest rates in the country go up, especially the short-term and the long-term interest rates, that pushes up the rates that credit card companies and mortgage companies charge their customers for having a mortgage or a credit card. Mm-hmm. And if they raise rates too high, too fast, it'll raise the minimum debt payment to service that debt. Yep. And you'll have a lot of people and businesses going bankrupt, and a lot of homeowners going bankrupt when that happens. I think initially prices will stay this way, but as interest rates start to go up, I think what will happen is it'll cost more to buy a home, and the prices of houses should go up even higher. But as interest rates start to go up, it'll cost more to buy a house and to service a mortgage. So the value of the house, a mortgage will go. The interest rates that charge on a mortgage will go up. Yeah. But the value of the house will go down. Okay. Which is what we saw in the United States. The housing market, interest rates stayed low. There's raw irrational exuberance, and in the American housing market. Mm-hmm. And once the interest rates start to go up, people start defaulting on their mortgages. Oh, I see. Okay. In some cases. Now I'm going to have to cut you off there. Okay. I might have to edit this a bit, cut some things out. I don't want to do that. I'm going to have Shawn back as often as I can. Basically, I just wanted to recap while we have a few seconds here. Keep your eye on interest rates. Don't do anything too rash. Watch the markets and look at not going into commodities or major purchases quite yet. Buy a car, not a house. Thanks.